Imagine your star quarterback throws for, I don't know, 400 yards and 5 touchdowns in a crucial playoff game.
Right, like a total blowout.
Exactly. 0 interceptions, massive victory. But then, during the post-game press conference, the head coach completely ignores the win.
Just pretends it didn't happen.
Yeah, he steps up to the podium and just deadpans that they're completely overhauling the offensive playbook, and they plan to pass the ball 20% less next season.
Oh, wow. So the crowd just turns on them.
Exactly. The stadium doesn't cheer the victory they literally just watched. They start booing the team off the field.
It's the ultimate narrative whiplash. You're looking at a scoreboard that displays this undeniable, quantifiable victory, but the entire stadium is just completely discounting it.
Yeah, they're pricing in a dismal next season.
Right. Based entirely on the coach's tone and like a few opaque strategic shifts.
Well, welcome to Talk Tickers. This deep dive is all about that exact psychological whiplash. That is the phenomenon we are unpacking today.
And we really need to set a sober tone for this one.
We do, because if you're managing your own portfolio or, just trying to understand the often irrational mechanics of the stock market, you know that surface-level earnings recaps just don't tell the whole story.
They really don't. You have to look under the hood.
Right? And today we're looking at the Q4 fiscal year 2026 financials and the FY27 guidance of a massive player in the database infrastructure space.
MongoDB.
Yes, and they just took an absolute beating. I mean, a brutal 24% after-hours haircut.
Breathtaking is really the only word for it. I mean, to put the actual capital destruction in perspective here.
Please do, because the numbers are wild.
We are talking about an asset that closed regular trading on March 2nd at roughly $325 a share.
Okay, $325.
Right. Then the results cross the wire. The executive call happens at 5 p.m. Eastern, and by 8 p.m., the stock had plummeted into the $245 range.
That is a $79 drop per share in a matter of hours.
In literally 3 hours. And the bleeding continued into the next trading session on March 3rd. It touched an intraday low of $229.
On incredibly heavy volume, right?
Oh, massive volume. Over 12 million shares changed hands. Just total capitulation.
So here's the premise, the core tension that we have to resolve over the next hour or so.
Let's hear it.
How does a software company achieve the coveted rule of 40, meaning, their revenue growth rate plus their free cash flow margin equals 40 or more?
Which is the gold standard in software, by the way.
Right. So they hit that, they generate record cash, they completely beat Wall Street's top-line estimates, only to see roughly a quarter of its entire market capitalization vaporized overnight.
Well, to understand the sheer panic of that sell-off, we first have to thoroughly examine the absolute perfection that preceded it.
The trailing execution.
Exactly. The market reaction was so violent precisely because the numbers looking backward appeared basically flawless.
Let's get into the mechanics of those trailing numbers. I was looking at the top line, and they hit $695.1 million in revenue for the fourth quarter.
A huge number.
It's a 27% year-over-year increase, and it beat the Wall Street consensus estimate by $25 million.
Right.
In this macro environment where, enterprise IT budgets are heavily scrutinized, a $25 million top-line beat is massive. How does a beat of that magnitude result in a sell-off?
I would argue it's because investors have been conditioned to expect a certain composition of growth, right?
Yeah.
Not just the raw dollar amount.
The quality of the revenue.
Yes. But before we get to that composition, we have to acknowledge how pristine these numbers look in a vacuum.
Mm-hmm.
I mean, if you handed an institutional investor this Q4 tear sheet, redacted the name of the company, and just hid the future guidance,
They'd be ecstatic.
they would likely model a 10% gap up at the market open, not a 24% crash.
And the bottom line outperformance was, I think, even more aggressive than the revenue beat. Non-GAAP earnings per share came in at $1.65.
The street was only looking for $1.48.
Right. But I want to pause here because we need to establish a baseline for anyone analyzing software earnings.
Sure.
The GAAP EPS, generally accepted accounting principles, flipped to a positive 18 cents.
Which is a big milestone.
It is, but why is there a massive $1.47 gap between the GAAP and non-GAAP earnings?
Yeah. That gap is almost entirely driven by stock-based compensation, or SBC.
Which is everywhere in tech.
It's a critical concept to grasp when evaluating any modern tech company. To attract, top-tier software engineers, companies pay a significant portion of their compensation in restricted stock units rather than pure cash.
Right, because giving away ownership dilutes the existing shareholders, so GAAP forces the company to acknowledge that cost.
Correct. GAAP is strict about that.
hmm
But Wall Street analysts argue that stock-based compensation is a non-cash expense.
It doesn't actually drain the company's bank account today.
Exactly. So that they look at non-GAAP earnings, which strips out that stock expense, to get a better sense of the actual operating cash the business is generating.
So a non-GAAP EPS of $1.65 shows that the core business engine is wildly profitable on a cash basis.
Very profitable. The fact that even the strict GAAP number flipped positive to 18 cents means they're generating so much profit that it overwhelms even the massive dilution of employee stock grants.
Yeah, and when you look at the margins, that profitability story just continues. I mean, they delivered a 75% non-GAAP gross margin.
75%.
Operating income surged to $158.8 million, up from $112.5 million a year ago.
And look at the cash flow. Operating cash flow was almost $180 million, with free cash flow hitting $177 million just for the fourth quarter.
Just a cash printing machine. Which brings us to the operational metrics that drive all that cash.
Right, let's talk about Atlas.
Atlas, their fully managed cloud database product. It is the undisputed growth engine here. Atlas grew 29% year over year.
And officially crossed the highly anticipated $2 billion annualized run rate milestone.
$2 billion, that's huge. Plus, they added 2,700 new customers in this single quarter, bringing their total customer base to over 65,200.
It's massive footprint.
I want to dig into how those customers are spending, actually, because the net ARR expansion rate, net annual recurring revenue, ticked up to 121%, up from 119% a year ago.
That's a great signal.
Let's break down the mechanics of net ARR expansion for a second. Why is a number over 100% basically the holy grail for a software as a service business?
So net ARR expansion measures the spending behavior of a specific cohort of customers over a 12-month period.
Okay.
Imagine you take all the customers who were with the company exactly 1 year ago. You measure how much they were spending then and compare it to how much that exact same group is spending today.
So it isolates the existing customer base, stripping out the revenue from brand new customers they literally just signed this quarter.
Yes, and that isolation is vital because, a company will inevitably lose some customers to bankruptcy or competitors. That's churn.
Sure, churn happens to everyone.
Right, and some customers will downgrade their usage. But if the remaining customers buy more products, upgrade their tiers, or simply consume more compute power, that new revenue can offset the churn.
So a 121% expansion rate means that even after accounting for every single customer who left or downgraded, the existing customer base spent 21% more this year than last year.
Exactly. It essentially means the business grows by 21%, even if their entire sales team goes on vacation for a year and signs 0 new logos.
That is the definition of a land and expand business model.
Yep. You land a small initial deal with a single developer, and as their application scales, your database revenue expands automatically alongside them.
Okay, I have to stop the parade here, though.
Yeah, the reality check.
We have a 4% top-line revenue beat. We have operating margins that outperformed the high end of their own guidance by over 100 basis points to hit 23%.
Jet profitability.
Accelerating customer expansion. Where is the underlying weakness? What did the high-frequency trading algorithms identify in the milliseconds after this press release dropped to trigger a mass exodus of capital?
Well, the perceived weakness isn't in the total dollars collected.
No.
No, it's hidden in the composition of those dollars, the optics, the growth rates, and a severe distortion caused by the rules of enterprise software accounting.
Okay, this brings us to the first major conceptual hurdle we need to clear, the bundle distortion.
Yes. The dreaded bundle.
Break this down because management highlighted some staggering enterprise wins on the earnings call. They signed a massive $90 million cloud transaction, an Atlas deal with a large tech company.
Huge deal.
But even more surprisingly, they signed a greater than $100 million transaction with a global financial institution for their self-managed on-premise product, Enterprise Advanced, or EA.
Right. And that 100 million plus deal is the largest total contract value, or TCV, transaction in the company's entire history.
It's a monumental win.
It is. But this is where the strict rules of revenue recognition create a bizarre penalty for success.
How does that work?
When a company signs these massive hybrid enterprise deals that bundle both the cloud consumption product and the on-premise software license, the revenue attribution gets heavily skewed in the near term.
Let's thoroughly explain the mechanics of enterprise software revenue recognition here. Because I think a lot of people assume that if a company signs a $100 million deal, they just, add $100 million to their revenue that quarter.
Oh, definitely not.
Why does winning a massive bundled deal actually make their flagship cloud growth metric look worse?
It all comes down to an accounting standard known as ASC 606.
The accountant's best friend.
Or worst enemy. It governs the difference between recognizing revenue ratably over time versus recognizing it at a single point in time. Let's look at the cloud product, Atlas, first.
Okay.
Atlas is a consumption-based cloud service. Revenue is recognized ratably over time.
Let me try an analogy here. Is it like a massive all-you-can-eat buffet where you pay per plate?
That's a good way to look at it.
Like, you might sign a contract saying you intend to eat a lot of food, but the restaurant can't actually claim your money as revenue until you physically put the food on your plate and eat it.
That's a very helpful way to think about it. The company can only claim the revenue as the customer actually provisions the servers, uses the compute power, and stores the data.
So it's a slow drip.
Exactly. It is a highly predictable slow drip of revenue spread out over months and years, perfectly matching the customer's actual consumption.
Okay, so that is the ratable cloud model. How does the on-premise product, Enterprise Advanced, differ from that?
Well, EA involves selling a software license that the customer takes and installs on their own internal bare metal servers.
On their own hardware.
Right. Under ASC 606 accounting rules, because the company has delivered the software license and the customer now has full control over it, a significant portion of the value of that term license must be recognized up front.
At the exact point in time the contract is signed.
Yes. Or when the software keys are officially delivered.
So if the cloud model is paying per plate at the buffet, the on-premise model is like buying the entire commercial kitchen equipment up front.
Bingo.
The revenue hits the books like a tidal wave in a single quarter rather than a slow drip over 3 years.
Exactly, the dynamic. Now, apply that accounting rule to a massive multi-year bundled deal.
Oh, I see where this is going.
The customer is buying both the cloud consumption and the on-premise license in one giant contract. Because the accounting rules force the upfront recognition of the license portion, a disproportionate amount of the immediate revenue attribution for that specific quarter has to be tied to the EA portion of the bundle.
So the accounting quirk actively pulls recognized revenue away from the cloud side of the ledger for that specific quarter, effectively starving the Atlas metric.
That is the distortion right there. The CFO explicitly noted that without this massive bundle skew pulling revenue into the upfront EA bucket, the Atlas Cloud product would have grown at approximately 30% instead of the reported 29%.
Wait, all of this panic is over 1%.
Literally 1%.
And here is where market psychology and algorithmic trading takes over. We are talking about a 1% difference. To a rational human being analyzing the business, a $100 million deal is an absolute triumph. The cash is secured.
Absolutely secured.
But to a natural language processing algorithm that's programmed to scan earnings releases and value software companies based purely on the sequential acceleration or deceleration of their cloud revenue.
It's a disaster.
Missing that psychological 30% threshold is an immediate glaring red flag.
Because the headline simply reads, Atlas Cloud growth slows to 29%. The algorithms don't read the nuance of ASC 606 revenue reallocation buried in the footnotes.
They just execute the sell program in milliseconds.
Yep. The very size of their enterprise success triggered the sell-off because it broke the linear trajectory the market models demand.
That is a staggering realization. But it leads us to something else that is genuinely surprising in this report. It wasn't just an accounting trick. The actual underlying self-managed on-premise business was incredibly strong.
Unbelievably strong. The non-Atlas business, which is primarily that on-premise EA product, grew 20% year over year.
20%.
Management noted it was the best growth quarter for that specific segment in the last 2 years. And the metric that proves this isn't just a one-quarter accounting fluke is the remaining performance obligations, or RPO.
Let's define RPO deeply, because I see this term thrown around constantly on FinTwit and in research notes, but it rarely gets the explanation it deserves.
It's crucial.
What exactly goes into RPO, and why did it explode by 97% year over year to $1.47 billion?
So RPO is the ultimate measure of long-term customer commitment. Think of it as the sum of deferred revenue and unbilled backlog.
Okay, unpack that.
When a customer signs a non-cancelable 3-year contract for $30 million, but they've only been billed for the first year, the remaining $20 million goes into the RPO bucket.
Yeah, I see.
It is contracted, legally binding future revenue that simply hasn't met the accounting criteria to be recognized on the income statement yet.
So it's basically a massive shield against future macroeconomic downturns. Like, if the economy completely freezes tomorrow, they still have a legally binding $1.47 billion backlog to work through.
Exactly. Doubling that backlog in a single year is a massive signal of enterprise trust.
It is, and it forces us to completely reevaluate a core assumption that has dominated the software industry for the last decade.
The death of on-prem.
Right. I want to lean into that because for years, the market has violently punished any company with on-premise exposure. The prevailing wisdom dictated a pure cloud transition.
Move to the cloud or die.
Exactly. The narrative was simple. Move every workload to the hyperscalers like AWS, Azure, or Google Cloud, or you are a legacy dinosaur waiting to go extinct. But looking at these numbers, are we now seeing a permanent hybrid realization where mission-critical data simply must live on bare metal servers?
The data strongly suggests that hybrid architectures are not just a temporary stepping stone to the cloud, they're a permanent end state for heavily regulated industries.
Like who?
Think about global financial services, telecommunications networks, healthcare systems, and government agencies.
Ah, the heavy hitters.
Right. These entities are dealing with data sovereignty laws that require data to stay within specific physical borders. They are dealing with operational resilience mandates, where a public cloud outage simply cannot take down a national banking system.
They mentioned a very specific technical use case on the call regarding a company called Axon Networks. I want to unpack this example because it perfectly illustrates why the cloud isn't always the answer.
It's a brilliant example.
What is Axon doing that requires an on-premise database?
So Axon Networks is a global leader in telecommunications network management. They provide the software backbone for 32 different telcos, managing connectivity for over 90 million homes and enterprises globally.
That is massive scale.
Huge. And they selected the EA platform as the foundation for an operator-as-a-service platform. The core of this platform is a real-time digital twin.
Okay, wait. What exactly is a digital twin in the context of a telecommunications network?
Imagine a massive, complex physical network. Millions of routers, cell towers, fiber optic switches, and home modems. A digital twin is a living, breathing software replica of that entire physical infrastructure.
Like a simulation that runs parallel to reality.
Exactly. It ingests telemetry data from every single physical node in real time. So if a router in a neighborhood in Madrid experiences a sudden spike in latency, the digital twin registers that instantly, allowing the network management software to autonomously reroute traffic before the end users even notice buffering on their video streams.
Wow. To process that volume of telemetry data from millions of devices simultaneously, that requires an architecture that can handle massive, unpredictable spikes in time series workloads.
Precisely the challenge. When millions of people suddenly tune in to stream a live sporting event, or a major network backbone gets severed by a construction crew, the database has to process that peak load instantly.
And this is where the limitations of public cloud become apparent. You cannot rely on a public cloud data center located hundreds of miles away in Virginia or Frankfurt to process that telemetry without introducing latency.
The physics just don't allow it.
Right. A few milliseconds of delay might be fine for loading a retail website, but it is catastrophic for real-time network routing.
That is the critical differentiator. Axon needs the flexibility to run this digital twin across mission-critical environments, which includes both the public hyperscalers for non-critical analytics and their own localized bare metal servers for real-time routing.
They need both.
They require enterprise-grade security and operational tooling to support this hybrid deployment. The flexibility to run anywhere cloud or on-prem is no longer viewed by these massive enterprises as a legacy burden. It is a strategic necessity. They need their core, mission-critical data secured on a platform they physically control.
So the trailing execution is a fortress. The RPO is nearly doubling. The multi-cloud strategy is deeply resonating with massive telcos and financial institutions.
It's a great story so far.
But this brings us to the harsh reality of the forward-looking statements. We have to analyze the primary catalysts for the stock's collapse, the fiscal year 2027 guidance, and the sudden shuffle in go-to-market leadership.
This is where the narrative whiplash accelerates. Because despite the incredible trailing strength and the massive backlog, the forward outlook terrified institutional investors.
Let's lay out the exact numbers of that guidance. For fiscal year 2027, management guided total revenue to a range of $2.86 billion to $2.90 billion.
Which sounds like a lot, but
That implies full-year revenue growth of only 16% to 18%. For a company that just posted 27% growth, a deceleration to the mid-teens is a massive psychological blow.
no, absolutely.
Furthermore, for the immediate first quarter, Q1 non-GAAP EPS was guided to $1.15 to $1.19, which fell short of the Wall Street consensus estimate of $1.20.
When a hyper-growth software infrastructure company suddenly guides down to mid-teens growth, growth investors immediately start looking for the exit.
They don't stick around to ask questions.
No, they don't. But to truly understand if this is a structural breakdown or a temporary forecasting anomaly, we have to look at the philosophy behind the guide.
The methodology.
Right. The CFO spent a considerable amount of time explaining their forecasting methodology, and it revolves around the inherent lack of visibility in their two primary business models.
Let's explore that lack of visibility. Why is it so hard to predict revenue for a company with a $1.4 billion backlog?
It stems in the difference between traditional SaaS subscriptions and the modern consumption model.
Okay, contrast those for us.
In a traditional SaaS model, a customer signs a contract for, say, 1,000 user licenses at $10 a month. The company knows exactly how much revenue they will recognize every single month for the duration of that contract. It is incredibly predictable.
Right. But Atlas doesn't work like that. It is the buffet model we talked about.
Right. With Atlas, visibility is highly accurate for the next 2 to 3 months based on current workload trends. But it becomes extremely murky in the back half of the year.
Because you don't know how hungry the customer will be in November.
Exactly. The company simply does not know if a major enterprise customer is going to launch a new application in November that requires massive compute scaling, or if they're going to optimize their code and reduce their database consumption by 15% to save money.
And what about the on-premise side, the EA product? That isn't consumption-based, so why is that hard to forecast?
EA is difficult to forecast because it relies on massive, lumpy, multi-year deals.
Whales.
Yep. When you are negotiating a $100 million contract with a global bank, the sales cycle is incredibly complex. It requires approvals from procurement, security, legal, the C-suite. A deal that is slated to close in Q3 could easily slip into Q4 because a single legal addendum needs to be rewritten.
So management's stance is essentially, we are only putting deals into our official guidance that have already closed or have an incredibly high statistical probability of closing.
That's their exact posture.
They're refusing to bake optimistic pipeline assumptions into their public forecast just to appease Wall Street's insatiable demand for sequential growth.
They are actively choosing to take the pain of a stock drop today to avoid a catastrophic earnings miss later in the year.
Which is prudent.
It is. The CFO explicitly stated they bake more upside scenarios than downside scenarios into their internal models, but they will not commit to them publicly. But the algorithmic market does not reward conservatism. It punishes uncertainty.
And what amplifies that uncertainty into outright panic is the leadership transition. It is one thing for an executive team to guide down conservatively. It is another thing entirely to suddenly change the very people responsible for hitting those lower numbers.
Oh, the go-to-market leadership transition is arguably the single biggest red flag for a fundamental analyst.
Let's name names.
Cedric Peck, the president of field operations, and Paul Capbasis, the chief revenue officer, are both leaving the company.
These are the two primary generals responsible for driving the global sales army.
That's a huge void. They are bringing in Erica Volini as the new chief customer officer. She brings a massive pedigree, having served large enterprises as a partner at Deloitte and scaling go-to-market growth strategies at ServiceNow.
She's highly qualified. But crucially, the search for a new permanent chief revenue officer is still ongoing. The current CRO will stay through Q1 and advise through Q2 to ease the transition, but the seat is effectively vacant for the long term.
If we synthesize the de-risking behavior of the market, the timeline looks terrifying. You have a company simultaneously guiding down top-line growth to the mid-teens while announcing the departure of the executives who built the sales engine.
It looks bad.
The market's immediate assumption is severe execution failure. Investors assume the departing executives looked at the pipeline, realized the targets were unachievable, and decided to leave rather than pilot a sinking ship.
I have to challenge that assumption, though. Is this a genuine structural breakdown in enterprise demand, or is management just playing the classic corporate game of kitchen sinking the guide?
The old kitchen sink.
Let's unpack the psychology of corporate sandbagging for a moment. You have a relatively new CEO who has only been in the seat for a few quarters. You are about to hire a brand new chief revenue officer. The oldest, most reliable trick in corporate governance is to lower the forward guidance so dramatically that the new executive team can easily step over a lowered bar.
It is a deeply ingrained corporate playbook.
Because you never want to recruit a superstar chief revenue officer and hand them an unachievable quota on day one.
It destroys morale, it ruins commission structures, and it leads to immediate turnover in the lower sales ranks. Resetting expectations to a floor you know you can beat is standard operating procedure during a major leadership transition.
You essentially sink all the bad news into one terrible quarter so that every subsequent quarter looks like a miraculous turnaround orchestrated by the new leadership.
And to your point, the CFO even admitted on the call that the leadership change inherently adds a level of operational uncertainty, and they explicitly factor that transition risk into the lowered guidance. So your theory holds significant weight.
But the after-hours trading algorithms don't care about the nuance of executive quota sitting. They parse the text, see slowing growth juxtaposed with executives departing, and execute a market sell order.
Which brings us to the friction point of the entire narrative. The market is demanding immediate, predictable revenue, while the company is trying to build foundational infrastructure for a technological shift that hasn't fully arrived yet.
AI.
Exactly. This is our fourth core area of analysis, and perhaps the most heavily debated topic in the entire software ecosystem, the AI reality check.
Let's deconstruct this AI narrative. The company is positioning itself incredibly aggressively as the foundational data layer for artificial intelligence. They noted on the call that the usage of vector search and their proprietary embedding models, which they acquired through a company called Voyage, has literally doubled year over year.
The adoption metrics are undeniable. They highlighted marquee AI-native wins that prove their architecture functions at the absolute bleeding edge of machine learning.
We need to build a technical foundation here before we talk about those case studies. For the investor trying to understand the AI stack, what exactly is an embedding and what is vector search? Why is it so crucial for AI?
To understand vector search, you have to understand how large language models actually process information. AI models do not understand the English language.
Right.
They do not know what the word apple means. They only understand mathematics. So when you feed text into an AI model, the first thing it does is translate that text into an embedding.
An embedding is basically a massive array of numbers, right? A coordinate on a multi-dimensional graph.
Exactly. It takes a concept and plots it in mathematical space. The word apple might be plotted near the word orange because they're both fruits, but far away from the word car.
Makes sense.
Vector search is the database technology required to rapidly search through billions of these mathematical coordinates to find concepts that are semantically similar.
So it isn't just looking for an exact keyword match. If I search a traditional database for dog, it only returns documents with the exact word dog. But if I use vector search and search for dog, it understands the mathematical proximity and might return documents about puppies, canines, or wolves, even if the word dog is never used.
That semantic understanding is the entire foundation of modern AI applications. And this is where the architectural difference between a legacy relational database and a modern document database becomes the bottleneck.
Let's dive deep into that architectural difference. Why can't a company just bolt a vector search engine onto an old SQL database like PostgreSQL or Oracle?
It goes back to how data is stored. Legacy relational databases built on SQL require data to be stored in rigid, perfectly organized rows and columns, like a massive Excel spreadsheet.
Very strict schema.
But AI models don't think in rows and columns. They process unstructured data text, images, audio, and they communicate using a highly flexible nested data format called JSON, or JavaScript Object Notation.
And MongoDB was natively built on a JSON document architecture from day one.
That is their massive structural advantage. If you use a legacy relational database for an AI application, you have to take the AI's complex JSON output, flatten it, translate it into rows and columns to store it, and then reverse the entire translation process when the AI needs to retrieve the context later.
It would be like an English speaker hiring a translator to translate a book into French, storing it in a French library, and then hiring another translator to turn it back into English every time they wanted to read a single paragraph.
The translation layers create massive latency.
Latency is the death of real-time AI. By using a native JSON document architecture and integrating vector search directly into the core platform, you eliminate those translation layers.
The AI agent can read, write, and retrieve context seamlessly without needing brittle data pipelines or secondary bolted-on systems.
Which explains the massive AI-native customer wins they highlighted. Let's look at Emergent Labs. They are a leading AI white coding platform based in India that just crossed a $100 million run rate.
Incredible growth.
Emergent powers nearly 6 million applications built across 190 countries. They're handling applications averaging 35,000 lines of code, with some reaching up to 300,000 lines.
That's serious complexity.
And they explicitly chose Atlas over PostgreSQL to power the AI agents that build these production-ready applications from natural language prompts.
That is a staggering validation of the architecture. PostgreSQL is the default open-source darling of the traditional developer world. For an AI coding agent handling 300,000 lines of code to explicitly reject Postgres in favor of Atlas speaks volumes about the latency and performance requirements at scale.
They also mention 11 Labs. For anyone who hasn't used it, 11 Labs is completely redefining conversational and voice AI.
They're everywhere right now.
They are expanding rapidly, sitting at $330 million of annual recurring revenue with an $11 billion private valuation. 11 Labs selected Atlas to power the critical long-term memory and knowledge base for their autonomous agents.
So the voice AI actually remembers you.
Exactly. They are using Atlas search and vector search so their voice agents can retain complex historical context and deliver personalized, natural interactions in real time.
And the list continues. Adobe expanded its strategic partnership to underpin new agentic experiences using Atlas vector search. Even Anthropic, one of the premier foundational model builders, was mentioned as a customer relying on the platform.
Okay, so they have the absolute biggest names in AI relying on their database architecture. The technology clearly works. But here comes the wet blanket on the entire AI hype cycle.
Here it comes.
Management explicitly stated on a call, and I quote, "AI is not yet a material driver to our results."
That sentence is the reality check that broke the stock.
Yep.
The market is currently demanding instant, massive financial monetization from AI infrastructure today to justify premium valuation multiples. But the truth from the front lines of enterprise software is that agentic AI is mostly stuck in the testing phase.
The CEO was asked a direct question about this reality gap by an analyst during the Q&A. He noted that he regularly asks Fortune 500 companies, massive retailers, healthcare giants where they are on deploying autonomous agentic workloads.
And the honest answer is, they aren't.
They aren't. They have built a few internal productivity apps to help their employees write emails faster, but they have built almost nothing customer-facing at scale.
The financial payoff for providing the infrastructure is delayed. It is definitively a not if, but when scenario. The transition from internal testing to global customer-facing deployment will take years, not quarters.
But while the massive revenue inflection is delayed, the technological strategy is clear. The CEO laid out an engineering mandate that defines the next decade of software. He said, agents need to love the database as much as human developers do.
Let's expand on that concept. What does it actually mean for a piece of code, an autonomous agent, to love a database?
It comes down to the elimination of friction, right?
Exactly. Historically, this company's massive rise from a startup to a multi-billion-dollar enterprise was built on the fact that human developers found the document model incredibly easy and flexible to use compared to rigid SQL databases.
They could build applications faster without worrying about database schemas.
Now, they're attempting to replicate that exact dynamic for machine agents.
Because an autonomous AI agent isn't just a simple script that executes a single command and shuts down. It is designed to run complex, multi-step workflows autonomously over hours or days.
Right. To execute a multi-step workflow, an agent needs memory state. It needs to remember what happened in step 1 to correctly execute step 4. It needs to autonomously access proprietary company data to make accurate decisions.
The plumbing has to be perfect.
The future strategy relies on building machine-friendly application programming interfaces APIs so that these AI agents can autonomously provision database nodes, store their memory state natively, and auto-scale compute power without a human engineer ever touching a keyboard or authorizing a server spin-up.
That is an incredible vision for the future of autonomous software. But as we've established, the market isn't paying for visions right now. They're paying for current quarter revenue.
Which brings us to the investor context segment.
Yes, we have to zoom out and look at the macro software environment. Why is the market so unforgiving right now? Why does a solid trailing beat and a conservative forward guide trigger a catastrophic 24% collapse?
Context is everything in capital markets. If you look at the total return benchmarks, the software sector is currently enduring a brutal digestion period. The IGV software ETF is down nearly 22% over the last 3 months.
22% for an ETF is a massive move.
By contrast, the broader NASDAQ 100 is relatively flat over that same period. The market has become hypersensitive to software consumption durability.
Investors are terrified that the massive cloud optimization trends of the past 2 years where companies ruthlessly cut their IT budgets aren't actually over.
And more importantly, they are questioning whether AI-native workflows will actually expand the total enterprise IT budget, or if AI spending will just cannibalize existing software budgets.
Rob Peter to pay Paul.
Exactly. The macroeconomic environment has violently shifted from the zero interest rate era of growth at all costs to a new paradigm of profitable growth with absolute predictability. Any hint of deceleration, any excuse to de-risk a portfolio, and the algorithmic trading systems will indiscriminately sell.
But this is where the divergence between the market's panic and management's confidence becomes the most stark element of this entire analysis. While the market is indiscriminately dumping the stock, management is aggressively buying it back.
The cash generation metrics are the ultimate proof of management's internal confidence. The CFO noted they made meaningful progress in cash management, driving their operating cash conversion rate to over 100% in fiscal 2026, a massive improvement from roughly 50% in prior years.
Going forward, they're targeting an 80% to 100% cash conversion range.
And what are they doing with that massive pile of cash? They are committing 100% of their fiscal year 2027 free cash flow to share buybacks and settling employee RSU taxes in cash instead of issuing new shares.
They generated $177 million in free cash flow just in this single quarter. If they maintain that operational efficiency, we're talking about hundreds of millions of dollars deployed directly into eating up the available share float.
It is a massive structural vote of confidence. Management is essentially broadcasting a message to the market. If Wall Street wants to price our infrastructure as a decelerating legacy asset based on a conservative guide, we will gladly use our massive cash flow to buy our own company at a steep discount.
It creates a synthetic floor under the stock over the long term. By buying back shares, they offset the dilution of the stock-based compensation we discussed earlier, reducing the total number of shares outstanding and artificially boosting the earnings per share for long-term shareholders who can stomach the near-term volatility.
If you are looking at your portfolio construction right now, you are faced with an incredibly difficult valuation exercise.
How so?
In a market demanding instant AI monetization to justify high multiples, how do you value a foundational pick-and-shovel infrastructure play? They are providing the exact tools the AI developers need: the memory state, the native JSON architecture, the multi-cloud resilience. But they openly admit the material AI revenue is still a year or two away from reflecting on the income statement.
It requires an iron stomach and a multi-year time horizon. You have to firmly believe that the transition year, the conservative guidance, and the go-to-market leadership shuffle are temporary speed bumps on the way to becoming the default data platform for the agentic AI era.
Which naturally leads us to explore how a sophisticated investor might structure a trade to capitalize on this exact dislocation between short-term panic and long-term potential.
My favorite part of the show. This is the perfect time for our not financial advice segment.
Let's do it.
We are going to pitch a wildly creative, highly structured, but logically sound options trade. The tone here is confident, slightly aggressive, and heavy on the mechanics of volatility. The floor is yours. Pitch the trade.
We are going to construct a position I call the AI patience leapfrog.
The AI patience leapfrog. I love it.
The setup is screaming at anyone who understands options pricing. We just witnessed a massive implied volatility expansion followed by a crush event. The options market had priced in a roughly 14.1% move into the earnings print.
And the actual move blew way past that.
To the downside, dropping 24%. The market is currently pricing this asset as a decelerating dinosaur, completely discounting the fiscal year 2028 AI inflection point.
I follow the thesis, but the near-term growth is still guided to the mid-teens, and the chief revenue officer just left. Why are we trying to catch a falling knife in a volatile market?
Because we aren't catching it. We're letting management's buyback program catch it for us.
Ah, the synthetic floor.
Management is creating a synthetic floor. They are shoveling 100% of their free cash flow into buying their own stock, eating the float, while retail investors panic. We are going to use the options market to get paid for our patience.
Walk me through the actual mechanics of the trade. How do we structure this without taking on massive, unhedged, directional downside risk if the macro environment worsens?
We are going to execute a calendar put call structure. Let's break it down into two legs. Leg one, we sell near-term, deep, out-of-the-money cash-secured puts. We are looking at a 3-month expiry, striking roughly 15% below the current beaten-down price.
Let's explain why we are selling puts. When a stock drops $79 a share in a single day, the fear in the market skyrockets. That fear is measured by implied volatility or forfeit.
It shoots through the roof.
And because options pricing is heavily influenced by vega, the Greek metric that measures an option's sensitivity to volatility, the premium on those put options becomes astronomically inflated. People are overpaying for downside protection.
Exactly. We step in as the liquidity provider and aggressively harvest that inflated premium. We collect cash today, taking on the obligation to buy the stock even lower if the bottom completely falls out. But we do not just sit on that collected cash.
Which brings us to leg two. What do we do with the premium we just harvested?
We take that exact premium from the fearful put buyers, and we use it to entirely fund the purchase of long-dated, out-of-the-money LA calls.
LAPs are long-term equity anticipation securities, right?
Essentially call options that expire a year or more in the future. Specifically, we are buying calls expiring in January 2028.
I see the structural brilliance of the trade. You are creating a synthetic free roll.
We are getting a mathematically financed free roll on the entire AI inflection thesis. Let's look at the two likely scenarios.
Lay out scenario A.
Scenario A. The stock chops sideways or bleeds slowly over the next 3 months. Management's relentless buybacks eat the supply, providing underlying support. Our short puts expire completely worthless due to theta or time decay, and we keep the premium, which is already paid for our LAPs.
We hold the E's for free. And scenario B.
Scenario B. Agentic AI goes from a whiteboard casting buzzword to a commercial reality in the next 18 months. Those Fortune 500 companies move from internal productivity testing to deploying millions of autonomous customer-facing agents.
And those machines start autonomously spinning up database nodes and consuming compute via those machine-friendly APIs.
The revenue re-accelerates massively. If that happens, those January 2028 yearly pay calls will print massive asymmetric returns. We are effectively letting the short-term panic-selling algorithms finance our long-term structural AI infrastructure bet. We monetize the immediate fear to fund the inevitable future.
It is a beautiful, aggressive structure that uses the market's short-term panic against itself. But it is vital to remember that this is a conceptual exercise to explore the mechanics of volatility and narrative dislocation. Options trading involves significant risk, including the potential loss of your entire capital base, and this segment is strictly for educational and entertainment purposes. Do your own due diligence and consult a professional before executing complex calendar structures.
The mechanics of calendar structures and ELEAPs require precise timing, margin management, and risk tolerance. But as a thought exercise in how to exploit narrative whiplash, it perfectly illustrates the divergence between short-term pain and a long-term technological thesis.
Which brings us to the conclusion of today's deep dive. What a phenomenal, dense breakdown of a truly chaotic market event. Let's recap the highlights of this narrative whiplash to solidify the core takeaways.
On one hand, you have pristine trailing metrics, a Rule of 40 software infrastructure company generating massive quarterly free cash flow, seeing its long-term remaining performance obligations nearly double, and signing the largest enterprise deals in its history with global financial institutions and telecommunication giants.
Right. And on the other hand, you have the reality of software accounting pulling revenue away from the cloud growth metrics, an incredibly conservative forward guidance philosophy forecasting mid-teens growth to account for consumption uncertainty, and a sudden void in go-to-market leadership with the departure of the executives responsible for global sales.
It is a textbook example of how the market inherently values forward certainty over historical performance. The trailing 12 months belong to the accountants and the operators who executed flawlessly.
But the forward 12 months.
Those belong to the algorithms and the momentum traders. And right now, the algorithms are demanding absolute clarity on the timing of AI monetization, which management honestly admitted is still on the horizon, not in the current quarter.
It is a painful transition year for the stock, but one that sets up a fascinating technological future for the company itself. Once again, a final reminder that this deep dive is for informational and entertainment purposes only and does not constitute individualized financial advice.
Keep that in mind.
But I want to leave you with one final, lingering, provocative thought to mull over as you digest all of this information.
We spent a considerable amount of time discussing the company's new engineering North Star, building database infrastructure that autonomous AI agents love to use.
The vision of machines autonomously provisioning nodes, evaluating technical specifications, and scaling enterprise software directly via APIs without human intervention.
Yes.
Let's play that out to its logical conclusion. Fast forward 5, maybe 10 years into the future. If machines and autonomous software agents become the primary entities evaluating, provisioning, and scaling enterprise software infrastructure, do human B2B sales teams even matter anymore?
It's a scary thought for the industry.
If the entire procurement system is fully automated and machine to machine, do we even need a chief revenue officer taking clients out to expensive steakhouses to close a massive enterprise deal? Or, at the end of the day, when the agents finally take over, does the best code simply sell itself to the bots?